Hi there. Welcome to Morning Markets. I'm Lindsay Biscaya. Let's get to some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bloomberg is reporting Canada Pension Plan Investment Board has halted its sale of fund stakes. Additionally, La Caisse is suspending an undertaking to sell an estimated $1.5 billion of Chinese private equity assets. Now, according to the report, the potential sales were stopped as buyers offered to take the portfolios at discounts deeper than their expectations. Keyera, AltaGas, and CN Rail are partnering to advance the Alberta Corridor Export Rail Terminal project. The partnership includes an initial investment by Keyera of about $240 million. It combines Keyera's ACE Rail Terminal with CN's rail network and AltaGas's West Coast export platform. The companies say the project will strengthen Canada's energy competitiveness as well as expand access to global markets. And Sherritt International is in talks to hand a controlling Cuba mine stake to Gillian Capital. That company is linked to a former advisor of U.S. President Donald Trump. Sherritt says it has signed a non-binding agreement which would allow Gillian to acquire enough common shares to own more than half of the company. And we're watching the TSX today to see if it can make more gains. It's up more than a full percentage point at the moment, led right now by infotech and real estate sectors, followed closely by materials. So it's in the green. U.S. markets also in the green today for a couple of reasons, but investors do seem to be awaiting Nvidia's results for clues on the direction that the tech sector is going in. Nvidia reporting after the bell today, and we're watching that. But right now, the S&P 500 up 0.8%, the NASDAQ up more than a full percentage point. U.S. stocks are making gains, led by the NASDAQ, as you just saw. And as we mentioned, Nvidia is set to report earnings after the closing bell. And investors are hoping for another stellar quarter. The report will offer a view into the AI trade and provide the latest update on demand for chips. So let's get perspective now from Brian Belsky, CEO and Chief Investment Officer at Humulus Investment Strategies. Good morning. Thanks for joining us.
Thanks for having us. Good morning, Canada.
What are you watching for in Nvidia's earnings today? It seems as though there's a lot of pressure right now, obviously, on this company.
There's been a lot of pressure for about 6 to 8 quarters here, and Jensen's delivered. It's delivered because at the end of the day, there's been so much momentum, so much talk about AI, so much talk about Nvidia's part in this, but it really speaks to why we own the stock, why stock pickers have owned the stock, and why it's so important. Because when it comes down to it, you're talking about product, management, deliverables in terms of what they've done with respect to earnings, returns, cash flow. This is the quintessential thematic stock picking name, and not just because of the big theme of AI, but because he's been able to deliver. So we think that we're going to hear the $1 trillion number from Jensen after the close and numbers in terms of what the market is for what he's trying to do in AI, number one. Number two, the stock had underperformed the first 3 or 4 months of the year, and we think that's given an opportunity for those investors that kind of missed it to get in. And then number three, we do believe that Nvidia is really the core of the Apple of AI. And so we continue to believe that AI is in the very early stages. If it's a baseball game, if it's a Blue Jays game, I'll talk Canadian here, it's probably in the 3rd inning or so, maybe 4th inning. And the rest of the game is yet to come.
And I appreciate, that there's been pressure on Nvidia for a long time, but obviously we've seen continued growth. And so as Nvidia continues to grow as a company and in value, that pressure continues to build as well. When it comes to Nvidia versus some of the other big tech names that we've seen reporting recently, what are your thoughts? Do they compare?
Well, I think they set themselves apart from a valuation perspective, not only in a product perspective, but if you take a look at what we view as kind of the core leaders, which would be Nvidia, Apple, Google. These numbers and these companies continue to deliver. They're setting the pace. We've had the ins and outs of these flows with respect to the AI trade, whether or not it's hardware to software to semiconductors to memory, back to trying to bottom fish software. I think if you would have just kept along with those 3 names and kind of kept with those core competencies of the company management is what they've been able to deliver from Google's venture with Apple to Apple saying we're going to hold back and wait for the AI side of things in terms of what we're going to back with respect to what kind of software platform, to Nvidia kind of setting the pace. So that's why we've maintained our positions there, and why we remain bullish on those names, and really, quite frankly, haven't chased a lot of the momentum names that so many of the investors have been chasing, let's say, the last 4 to 6 weeks.
And we're seeing today, obviously, another round of layoffs from Meta, laying off thousands of employees as it continues to invest in AI. So as you're talking about, a lot of this big spending that these companies are doing, particularly for AI, I'm assuming we can expect more of that in the future. We can with Meta, at least, but with these other companies, too.
Yeah, now Meta's a name in terms of transparency that we have not owned at our various places where we've worked in the portfolios that we've run since the fourth quarter of 2018. And so there's a very specific reason for that with respect to why we think what we think in terms of Meta. That trade clearly has paid off this year. It's really been behind the wall in terms of what's been going on with AI. And so this is another great theme in terms of stock picking, where we believe you don't have to own everything, and you should own the best companies with respect to that going forward. It doesn't mean that Meta is not a stock that people shouldn't own. It just means that we don't own it with respect to how we kind of take a look at the world of AI and the world of computing going forward.
Okay, so let's zoom out a bit now and talk about markets as a whole. We've seen them pull back in recent days over AI disruption fears, concerns over rising inflation. They seem to be on a bit of a run today. What's your take on the direction of the markets that we've seen this week?
Well, I learned a long time ago that stocks are rarely linear for long in both directions. They don't go straight down for a long time, and they don't go straight up for a long time. And we've been straight up for several weeks in a row. So the market was ripe for some sort of a pullback, and I think it's very healthy that we've given a little bit back here. I think some of the moves that we saw from a technical perspective and price performance perspective were way ahead of fundamentals. And the nice thing about what we've seen in some of these big trades in tech stocks is that they do ultimately longer term have a lot of fundamentals behind them in terms of where earnings are. We just think on a near-term basis, they got a little bit stretched. And so I think the big issue right now is more on the inflation side with what bonds did yesterday. Obviously, the bond market is going in a different direction today, and that's why you have banks doing what they're doing, and small caps are working as well. But I think there's still some residual fears in terms of the wherewithal and staying power of inflation. Inflation stayed around way too long in 2022 and 2023. It goes up like an elevator, but down like an escalator. And I think many investors are worried that the escalator is going to get stuck again, especially concerning what's happened to WTI and then oil prices. That's what's helped the energy stocks outperform, especially those energy stocks that are the most correlated to WTI, and then, of course, in Canada, Western Canadian Select. So at the end of the day, I think that this too shall pass. If you take a look at what's happened in oil, it's risen pretty dramatically and go right back down dramatically as well. So that's kind of our view on that. We're more neutral on that, on oil in particular.
We're running out of time, but I just did want to ask you one last question about Canada, and if you are looking to kind of increase any exposure in any sectors within Canada right now.
We love the industrial sector in Canada. We also like consumer land in Canada. Aritzia is by far our favorite stock in Canada, has been for a long time. We just think that that's a great place to be. But industrials in Canada are, I think, are under-owned space, especially companies like Western Canadian Select. Waste Connections and GFL. We love the garbage business, and we think that those two stocks have been very under-owned by investors historically in Canada.
Okay, Brian Belsky, CEO and Chief Investment Officer at Humulus Investment Strategies. Appreciate your time. Thanks for joining us.
Thank you.
Coming up, Agnico Eagle is making a major bet on Canada's north, greenlighting its Hope Bay project in Nunavut. When we come back, we sat down with the company's CEO. That conversation right ahead. Agnico Eagle is placing a massive bet on the Canadian Arctic. The gold giant announced yesterday that they are greenlighting a $2.4 billion redevelopment of its Hope Bay project located in Nunavut, one of the biggest capital commitments in the mining sector this year. We got more from Agnico Eagle President and CEO Ammar Al-Jundi today.
This is a fantastic project. It will be producing almost 450,000 ounces a year at cash costs of about $950 US. So Roger, the cash generated by this, based on current prices, is in excess of $3,500 US per ounce. You work out the numbers, that's about $1.3 billion US every year of cash generated. So you might say it's a bet. I think it's a pretty fantastic bet, and it'll make a lot of money for our owners. At the same time, it's great for Nunavut. This will be our third operating mine in Nunavut. To put this into perspective, Roger, we represent about 25% of the entire economy in Nunavut. We purchase and do business with over $1 billion US in local entities. We employ 3,700 people up here. We pay about $600 million a year US to various Inuit organizations. And finally, this is great for Canada. This is a large investment, a large industrial investment, a large economic investment, and for the communities in a very strategic part of Canada's north, right on the Northwest Passage. So it's a great investment for our owners, it's a great investment for the community, and it's a great investment for Canada.
Now, you've got the other two mines going up there. This one, do you see it being fairly similar, or are there new challenges on this one?
This will be the fourth mine we've built in Nunavut. We've been here for 20 years. The process plant is really just a copy of something we've just built at Meliadine, which is also in Nunavut. So Agnico Eagle, I'm proud of everything we do around the world, but I think we are exceptionally good at operating in this kind of environment. Again, we've been here for over 20 years, and we run a very successful business in Nunavut.
And I guess one of the things always is power up there, energy costs up there. Do you expect to be, you're looking at the $25 million federal funding from the government, and a 37 megawatt, diesel plant, and the 4.2 megawatt Inuit-led wind farm. Is that going to be enough? And diesel, how much of a concern is that? It's I believe 10% of your operating costs?
Yeah, roughly. So the diesel in this part of the world, you're not connected to any hydro grid. It's just the distances are massive, as you can imagine. So we operate primarily with diesel. We've been doing that for 20 years. The one thing I would say as an engineer is, while we operate with diesel, we can run much more efficiently because we take all of the heat off, take the engines to heat the plant and heat the people, the accommodations, etc. But you raised a very interesting point. The government is helping us to put in place, well, actually it's helping the Inuit community to put in place a windmill. It'll be owned and operated by the Inuit communities. We will buy power from them. So it not only allows us to have green energy, but it creates a long-term sustainable business for the Inuit communities around us. And we're starting with one windmill, but we're hoping to have up to 5 or 6. And if we get those 5 or 6, that will be enough effectively to supply power to the entire mine, clean power, and a lot of long-term revenue and business opportunity for the Inuit communities to add to what they're already working with us.
And you have it, you expect 11 years initial lifespan. Do you think you can expand that? And where do you get the confidence for that?
This is going to be, in my opinion, a multi-decade operation. The way it works, Roger, is you spend money exploring. We've hit this very hard. We acquired this 5 years ago from a company that was going to be a Chinese owner, and the Canadian government wasn't comfortable with that, given the strategic location. We acquired this 5 years ago. We hit it hard with exploration. We've got a project now that is very profitable, but the way it works in our business is you do exploration until you know you have a profitable project, then you move forward. We have only just started to scratch the surface on exploration. We're only at the first 12 kilometers of 2 parallel 80-kilometer greenstone belts. The areas that this first 12 kilometers are still open at depth. So we are exceedingly confident that this is going to be a multi-decade world-class mine.
That was Agnico Eagle President and CEO Ammar Al-Jundi. Coming up, today's market drivers with Bloomberg's Monique Malima. Right after this, stay with us. Okay, time now to take a look at today's market movers. We are joined by Bloomberg Equities reporter Monique Malima to break down a couple of different companies here. Monique, great to see you. So we're starting with Constellation Energy. This company is up more than 6%. Tell us why.
Yes, so Constellation Energy, their shares are up this morning after PJM, which is the largest grid operator in the U.S., announced that they were making changes to some of the agreements they had in place. They're going to be moving up the ability for data center operators and power providers like Constellation to be able to bid on power together. It was originally going to be in September 2027, and it's now going to be in September 2026. And this is something investors had really been looking for. A lot of power producers are now moving towards powering the energy demand for artificial intelligence data centers. And with these changes, they'll be able to capitalize on that more quickly. And analysts also say this might also help with them getting more contracts because there had been some people who were kind of waiting on the sidelines to see what was going to happen with PJM and some of the other grid operators. So that's why we're seeing their shares higher this morning, and some of their peers are higher today as well.
You're also watching holding company Red Cat. This company is rising after a recent acquisition. So tell us more about Red Cat and this acquisition.
Yes, so Red Cat, they are a drone company, and they announced that they have bought Quebec-based Quaise Technologies. And Quaise is power transmission wirelessly. So Red Cat said that this is going to be really important to their business. Currently, for the drones, they've been facing some difficulties with how to recharge them or how to give it more power while they're in operation. But with joining with Quaise, they're going to be able to use that technology to be able to refuel them while they're in the field. So they say this is really going to help with their operations. It's going to make things more efficient. So they're planning to use the technology for their own business. And they say they're also going to have Quaise sell this technology to other equipment manufacturers as well. So that's why we're seeing their shares trade higher, because it's going to benefit them both in terms of bringing in a new revenue stream as well as making their products more efficient.
You're also watching Lumina Metals today. We've been talking about them quite a bit. They're up not too much, like 0.4% at the moment. Tell us more about Lumina Metals.
Yes, so Lumina Metals, they had their IPO in April, and today was the first day that analysts could initiate their ratings on the company. And of analysts tracked by Bloomberg, they got buy ratings across the board. So that's why we're seeing the bit of a boost in shares. And also really positive on the company's silver and copper deposits in Poland. They say that it's a high grade. They have a large amount of silver. They'll be quite a big producer globally once that mine is up and running. So they're really positive on the outlook for that. And they say the company also has a strong balance sheet, which should help it to be able to make more deals in the future. But they do know one of the sticking points right now is in Poland, where this mine is located, there is a higher tax rate for mining compared to other jurisdictions. The company has signaled that they think that the Polish government is open to making some reforms to those taxes. So analysts are really waiting to see, are those going to come through? Because that's obviously going to impact the margins for the company if they're dealing with a higher tax rate. So that's just the bit of a pause that some people have right now.
Yeah, you're also watching Cava Group. This is the last one we're going to talk about today. It has raised outlook despite fears recently of a kind of restaurant downturn. Cava's feeling pretty optimistic about the rest of this year. Tell us more.
Yes, so like you mentioned, they raised their outlook. There's been some pressure in the restaurant industry as people have been pulling back on their discretionary spending as they're dealing with higher prices for things like fuel. So we've seen some restaurants kind of be more muted in their outlook, but Cava is really optimistic. And part of this is due to the fact that for some of their products, they haven't raised the prices. So in the US, their chicken and their falafel bowls are still $12, even as other food costs have risen. And they say that this is really helping them to still maintain the cost-conscious consumer and really continue to be able to grow their business, even as people are pulling back in other areas, with this being one of the few food items that the price has kind of been maintained over the past year. So they see more growth for that ahead and for their business more widely.
Okay, Bloomberg's Monique Malima. We will leave it there. Monique, thanks so much. Coming up next, Saks Global CEO on navigating bankruptcy, shifting luxury demand, and why physical stores still matter. We'll get you the interview with him right after the break. Meta has begun a round of layoffs for thousands of employees. The previously announced restructuring will cut 8,000 jobs globally and aims to reduce costs as the tech giant invests heavily in artificial intelligence. According to reports, Meta's latest round of cuts is expected to hit its engineering and product teams. Additionally, more layoffs could come later this year. Shares of Lowe's are trading lower today after the home improvement company posted same-store sales that fell short of expectations. It also left its full-year outlook unchanged, citing housing market challenges. On the upside, the company reported profit that beat estimates. Shares of TJX are getting a lift. Meanwhile, the retail chain raised its sales and profit outlook for the full year as cautious shoppers spend more on lower-priced goods at discount chains. TJX also posted sales and profit in its latest quarter that topped estimates. On the downside, the company's fiscal 2027 outlook now assumes a higher cost of fuel, which will remain in place for the rest of the year. Some analysts note the higher costs will be unfavorable to profit. And we're watching the TSX today to see if they can continue gains up more than a full percentage point still to start the morning. In the green, same with U.S. Stocks. If we're looking at some of the major ones in U.S. markets, the S&P 500, Dow Jones, NASDAQ, all trading up today. The NASDAQ in particular, more than a full percentage point. Saks Global is providing an update on its recent progress in evolving business strategy in a changing retail landscape. Earlier, Bloomberg spoke with Jeffrey Van Ramdonk, CEO of Saks Global, who discussed the current state of the luxury market for partner brands and the continuing role of physical stores in its long-term strategy.
We filed for bankruptcy a little bit more than 4 months ago and have made significant progress because we've secured $1.25 billion of liquidity. We've entered in a restructuring support agreement with our lenders to provide $500 million of exit financing. And then we just got court approval for a disclosure statement. So where we are right now is that we are soliciting votes for the plan of restructuration. We have support from the lenders and the unsecured credit committee, which includes many of the luxury brands. And then confirmation is scheduled for early June and emergence late spring, early summer.
And some of the other legal issues that you had faced, including the dispute with Simon Property over some of those broken leases, has that been resolved as well?
The conversation with Simon came to fruition in a really positive way. David Simon himself really worked to make sure that the collaboration and the partnership spirit was there. And so we just filed yesterday that all those elements are settled, and we are continuing as great partners in many locations together.
There was a lot of hand-wringing when this bankruptcy was filed. People look at Saks, Neiman Marcus, Bergdorf as kind of being the pillar of a multi-brand luxury retail experience. And I even spoke with some of those brands who were very worried about what the loss of those stores would actually mean for the luxury retail space. Have you given them enough assurances that not only are you going to exit bankruptcy, but that your long-term plan is going to be viable to thrive?
So we've given a lot of assurance to the brands that, as I mentioned, the big groups are part of the unsecured credit committee and they're supportive of the plan. What the plan shows is that we will exit with about $700 million of available liquidity, that we are going to be profitable this year and grow the business to be a $9 billion GMV business. That is going to be done on a smaller, more productive, and more profitable footprint, and that is going to be more profitable because we'll sell more at full price. We are showing growth that is going to be quality growth, and that growth for us means growth for the industry because we will be buying more from the industry. And ultimately, we have a path to be double-digit EBITDA profitable. And I think that's really important to me. I came back to get this business out of bankruptcy, but to make sure that it is on stable ground and grows profitably, because the role you mentioned is real. We play a very big role in the industry. We buy about $3 billion at cost from the brands. That's revenue that feed their own businesses. And a Saks Global that speaks to the luxury customer that is stable and growing and profitable is a cornerstone of the industry.
I could understand how you can get to double-digit EBITDA. Was it by fiscal year 2030 was the idea. But then when I looked at some of your revenue growth numbers, I mean, we're talking about a compounded annual growth rate over the next few years of like 5, 6, 7%. Is that really achievable? When I look around the retail landscape right now, it's hard to find companies that have that type of compound growth rate.
So I think you need to put this in the context of where the business is today. The business last year had liquidity problems. Those liquidity problems led to lack of payment to the brands and ultimately lack of inventory. So we entered the holiday season with very low inventory and almost no shipment of inventory in November, December, January, and February. And so the performance of last year and at the beginning of this year is still negative compared to what we did pre-merger. And so we are looking over the next 2 years to go back to what we did pre-merger. And that is really a factor of having the inventory. We see that when we have the inventory, we sell it. It's just a notion that we didn't have the inventory at all times, and we now see the value of it. And then ultimately, it is the strength of the company together that we believe can outpace the industry.
I am curious about your relationship with them. I mean, your background before you ran Neiman Marcus and now Saks Global. I mean, you were a vendor yourself to a certain extent, or you worked for those vendors. Are you confident you're going to get most of them, if not all of them, back, the ones that you had prior to the bankruptcy and the issues?
I am confident in the sense that today, if I look at the top 200 brands that make the vast majority of our GMV, none of them have left us. Okay. So even today, knowing that we had payment issues last year, knowing that we went through a process, they all stuck with us. And if I look at the brands that are shipping today, we have more than 700 brands that are shipping. And we received in last quarter, which ended at the end of April, $2 billion of inventory, and that is 102% of what we intended to receive. So I think what's interesting here is we play a key role. When we are not well-financed, brands are worried. But as soon as they see the liquidity coming, as soon as they see a plan that focuses on customer, that focuses on profitability and on retail, we had a lot of activities that were not profitable and that were not retail, then they all rally and support. And I was in Europe over the last 2 weeks. All the conversations are about how do we scale growth? Because you need to put this business in the context of the global business. Luxury is being challenged today in many parts of the world. The US is the market that is growing, and we are the gateway to the US customer.
I am curious about the complexion of that market. There's been a lot of talk that, yes, well-to-do people are still buying luxury goods, but they're also doing it in a different way. Some are more cost-conscious to a certain extent, or value-conscious is maybe the way of putting it. Some are also gravitating more to the resale market rather than buying firsthand.
So if you look at the luxury brands and the luxury customers, it's very correlated to the high net worth individuals. We do a survey every quarter that we call our Luxury Pulse survey. It is a database of customers who engage with us. It's statistically significant. And what we saw is we asked them a couple of questions. So we asked them, how do you feel about your personal finances? And 76% of them said, I feel optimistic. And that's 11% up to last October. When we asked them, are you going to buy equal or more in the next 3 months? 57% of them said yes. And the willingness to pay full price is at its all-time high. And so I think from a standpoint of the luxury customer that really participate multiple times in luxury, that segment is very strong. We see that our top customers are up to last year, despite the fact that the company is not up to last year. So I do think that is a very strong segment. Now, I think what customers are a little bit is what you're saying, they're discerning. So they're looking for the brands that offer newness, that offer value for the price, and that offer a brand that has strong congruence with its offering. And when those three characteristics are there, we see that there's no price resistance and there's growth. I think the challenge is when the brand proposition is not as coherent.
That was Saks CEO Jeffrey Van Remdonk. Well, coming up, we're diving into big retail earnings after Target has posted its strongest sales growth in years, and TJX also lifting its outlook. More on that after the break. Earnings are in this morning for some well-known retailers. Target reported its strongest quarterly sales gain in years and raised its full-year sales outlook. And TJX raised its full-year outlook as well. We got more from Michelle Connell, president and owner of Porsche Capital Management.
The comps came in really strong, and it looks like their turnaround is definitely in play. But they do have another $5 billion that they need to spend this year. And when you look at it, the stock is off in the pre-market, and I think that may be because the stock is or was ahead of itself, up almost 30% year to date.
And with this, with what's going on with it, do we? I just completely lost my train of thoughts. I was looking at something. No, it's not your fault. It's mine. So where does it go from here, do you think?
You know, this is obviously a really concerning time for consumers, right? And even the best of consumers, where they're upper middle class or beyond, are shopping at Walmart and at Target. But the difference is that Target has less than 30% of their sales in food versus Walmart has over 60. And so that leaves a wide berth for discretionary items. And I think that may be some of the concern here. Always loved Target, full disclosure. We've owned it up until this point because I love it. It's a great turnaround story. You love to go in there and you can see everything quickly, whether you need it or not. But I think a lot of the turnaround may be in play here, and that even though they took up estimates and they took up their comps, doubled them, what their expectations are for the year, I think people want to sit back a little and see how it plays out.
All right, let's go on to Lowe's reporting a beat, but guidance was weaker than expected. Where does that leave Lowe's?
Also a turnaround play, but has not been as strong as Target. You've got people that are staying in their homes because it's too expensive to move, and a lot of people, at least in the U.S., have low interest rates. They may be spending, but they may want to improve and make their homes more comfortable, but they're not going to spend a lot and, redo an entire kitchen or a bathroom. They're going to do with small fixes, and that's what I think we're seeing related in their comps. And their comps were almost flat, and it was pretty unexciting. What I do like about Lowe's is they're taking up more share on the professional or the tradesperson side of things. But until we see larger budgets for consumers in general, because they're the ones hiring those tradespeople, I think we're going to continue to have some weakness, especially with the potential of higher interest rates affecting homeowners.
And with Home Depot's earnings, what does this say for the bigger picture, the macro for these companies in this sector? Excuse me, this sector.
I think it shows that the consumer is tapped out in general since the Iran conflict. The average household is having to spend at least another $400 more every month. And so how much room do you really have to spend on making things nicer in your home? Probably a lot less. And so until we see some sort of resolution in the Gulf and definitely lower food and energy prices, I think things are going to continue to be soft, in the home retailers like Lowe's and Home Depot.
All right, and then let's segue into TJX, Winners, HomeSense, Marshalls. They reported first quarter result, 27% results that exceeded expectations, and they raised their full year guidance.
Now, they've been a benefactor of what's been going on. There are a lower point retail store, or what's considered more of a discount retailer, and their CEO came out in March and said that they were benefiting from the closeouts and the bankruptcies of other retailers. They're swooping in and buying a lot of designer retail goods at high discount and putting them out in their stores. And I think that's why it's so strong. So if you're a family and you need to buy clothes, these are the types of stores you're going to go to. And it's especially nice when they have some great stuff that, in terms of their inventory, that you haven't seen in the past. And they're benefiting from the fact that less of us are going to a full price retail mall, and they're able to get those goods and put them in front of their consumers. So I think you're going to continue to see them have really strong numbers, unless we head towards a recession, which we're not close to.
All right, and let's go in a completely different direction. Nvidia, what can we expect from them and big tech in general? Where do you sit with that right now?
Also been an owner a long time, so I need to say that, and started off my career as a semiconductor analyst. I think they're going to have strong earnings. When the CEO came out with the CEO of Dell recently, it sounds like they have extremely strong demand, but it's gotten so big that always becomes a problem. There may be some supply constraint issues as well, because they can't make the AI chips fast enough. But I'm constructive on the stock. In March, the PE, or forward price to earnings ratio of Nvidia, was cut in half. It was a nice point to go and buy that stock. And I think in terms of its long-term outlook, I think it still looks compelling. I think it's one that you want to hold in your portfolio for the long term, with the AI theme continuing to be built out through 2030.
And bigger picture with tech?
I like tech, and probably maybe I'm biased because I started out as a tech analyst. But whether we have inflation or what's going on in the environment, we're going to continue to have this build out. 2026, we're looking at another $2 trillion. Every year thereafter till 2030, another $2 trillion. So that's a total of $8 trillion. So look at the names in the space that haven't run and aren't terribly unreasonable. I've stayed away from the names that are more commodity oriented, like the Micron, et cetera, that are more memory oriented, and stick with the companies that have something that's proprietary, like an Nvidia, or a Broadcom, or a Qualcomm, or even a Taiwan Semiconductor, which owns all the fabrication basically for AI. And I think you'll be okay.
That was Michelle Connell, president and owner of Porsche Capital Management. Coming up, we will discuss why traditional diversification of stock and bonds is now less reliable, considering inflationary pressures and geopolitical tensions.
Tonight,
what I don't understand is how they get it in.
bag tag switching victims want to know how the drugs they were wrongly accused of smuggling even made it into the airport.
It's like an open barn door where you can come and go at will.
Whistleblowers expose security gaps they say are putting passengers at risk. Tonight on CTV News and ctvnews.ca.
Traditional stock and bond diversification is becoming less reliable as inflation and global shifts keep markets volatile. As a result, investors are looking beyond bonds toward assets such as commodities, gold, and alternatives. And earlier, we spoke with Nate Thoff, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management, for his take on portfolio positioning.
The challenges are real when it comes to how we build portfolios these days for all investors. We have seen more evidence that bonds and stocks are not reacting like they historically have. And because of that reason, we need to be more thoughtful in how we build resilient portfolios for clients. And what do I mean by that? Typically, when bond prices go up and yields are falling, that's an environment where stocks are doing fairly well. And the opposite is true when bond yields are going up. So there's dynamics in the marketplace right now that aren't acting normal. And 2022 is a classic example of that, where both your fixed income and your equities disappointed at the same time. And our view is that we're not giving up on fixed income. Fixed income is an important part of every investor's toolkit. But the reality is we need to be much more thoughtful about how we're using that fixed income and the duration or the longevity of that fixed income that we're using. And also we need to think about other diversifiers when it comes to what should be in your portfolio to offset some of these challenges between the correlations between equities and fixed income.
Okay, so how are you using bonds then? What are you doing with them?
So from a bond perspective, because they are so important to a portfolio as a stabilizer, what we're advocating for in portfolios is to be underweight duration. So what does that mean? That means effectively you want to be overweight the part of the yield curve that's shorter duration. So the 1 to kind of 5-year time frame or up to the belly of the curve, perhaps as long as 10 years. But beyond 10 years of maturity, we're much more skeptical. And the reason for that is we are seeing globally bond yields rising. And when bond yields rise, bond prices fall. And in that environment, particularly historically over the last 30 years, we see some large forces in the market that have kept yields lower. One of those forces is Japan, believe it or not, because the world is very interconnected from a bond perspective. So now that yields are rising for the first time in decades in Japan, that is no longer serving as a floor for global bond yields. And because of that reason, we are seeing a lot of upward pressure or increases in term premium, as we call that, on the longer end of the yield curve, which is causing the problems around bond prices not acting as well as they need to, particularly in risk-off environments.
And is this a one-off, do you think, the situation we're sitting in right now? Is it a one-off, or is this maybe the new normal?
I don't think it's a one-off. Keep in mind, we went through basically a 30-year period from the early 1980s all the way until 2022, where bond yields pretty much went down from a yield perspective structurally. I think we're in an environment for the next several years or decades even that yields will traffic higher. And the reason for that is we're seeing massive increases in fiscal spending globally. We're seeing higher levels of inflation volatility as well as structural inflation. And for those reasons, we think term premium needs to gravitate upward. And so the structural shift is that it won't be a straight line, but we think the episodes of yields increasing are likely going to be more frequent going forward, and the overall structure of yield will likely rise in the coming years, which means we're in a very different secular environment for bonds than we were in the 80s, 90s, and early 2000s.
And how do you play that long term, and where do you, any idea where you see them ending up for a level?
So, that's a great question. Where does I'll use the U.S. 10-year, and the Canadian 10-year is very highly correlated with it from a direction perspective. But when you think about where the 10-year could end up, we could be talking about numbers at some stage in the next decade or two where we're talking about a 7 handle or an 8 handle over time. It's not going to get there in a straight line, but we're a long ways away from that. So if term premium is truly repriced appropriately, given the amount of fiscal debt that's out in the marketplace, as well as some of this volatility structurally that's existing through kind of reorganization of supply chains, we could see structurally higher yields in the decades to come. And again, it will probably be more gradual and not overly impactful, but at the same time, it is problematic for the pricing of those bonds in the next, let's say, several years, if not decades.
And I just want to go back for a second. You mentioned diversifiers. What are you looking at? How are you treating them?
So beyond fixed income, and there's a lot of opportunities here, I think, for clients to look at, we believe that a lot of clients are underweight parts of the real asset market. What do I mean by real assets? I'm talking about things like infrastructure assets, real estate assets, also things in the commodity space, energy, gold, silver. Despite the pullback that we've seen in gold and silver recently, we think there's some real structural tailwinds that could benefit those assets in the coming years. Infrastructure is a highly in-demand area. We talked about the build out of AI earlier, but AI infrastructure and the tangible assets that support AI is real high demand but limited supply. So the value of some of these commodities and infrastructure, in our view, is fairly early inning cycles for potential upside, and they do serve as a good replacement for some of your longer duration fixed income in a portfolio.
As the Snowbirds prepare for their farewell season, the city's tourism sector is bracing for a major blow once the Jets are grounded. CTV's Alison Bamford has more on the industry that is synonymous with the squadron.
The legendary Snowbird jet, an emblem of Canadian pride and an iconic symbol that puts Moose Jaw on the map.
We're road tripping back from Kingston. Me and my girlfriend just graduated, and we're stopping by all the big things.
Sam O'Brien first saw the aerobatic team perform in BC when he was just a kid.
Bit of a big thing, you know, they cause a stir. Got to see the Snowbirds when they're in town, even in BC.
Those are the types of experiences many say they will miss while the squadron is grounded after this season. It's a hard pill to swallow for the city's tourism sector.
Financially, it's not good and it will hurt.
This restaurant owner says sales increase 5-fold when the Snowbirds perform during Moose Jaw's air show, one of the biggest summer attractions.
People come from all over Canada, even the northern parts of the U.S. to watch these.
You can find signs of the iconic Tudor jets across the city of Moose Jaw, including here at the Western Development Museum, where tens of thousands of people visit every year.
Tourism in Moose Jaw is all about experiences, and we're storytellers, and it's about our culture and our heritage, and the Snowbirds are all entwined into that.
Tourism Moose Jaw says it understands the need to replace the aging fleet. For now, they're looking forward to the tourists this summer's air show will bring.
I think it's going to be huge.
Now that they know it will be the Tudor Jets' last. Alison Bamford, CTV News, Moose Jaw, Saskatchewan.
And join us today at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. You can send in your options trading questions now to knowyouroptions@bnnbloomberg.ca. Market Call is coming up next. Today on the show, we have Javed Mirza. He is a quantitative technical strategist at Raymond James, and we'll be taking your questions on technical analysis. Thanks for watching Morning Markets. We'll see you tomorrow.